Global uncertainties are likely to weigh on Singapore's economic growth in 2020. Risks to regional supply chains were initially reduced with the signing of the US-China Phase 1 trade deal. However, this has since been offset by the COVID-19 outbreak. Already, Singapore has seen 2020 GDP growth projections revised lower. The negative sentiment could also weigh on office demand, says CBRE research. As it is, island-wide office net absorption registered slightly over 1 million square feet in 2019, 32% lower than in 2018.
The commercial market, in the short term, sentiments would not be good, and that will basically hamper any expansion plans. In the mid to longer term, I think if Singapore handles this very well, the what we call notion of stability gets stronger and stronger, right? So Singapore would seem to be a better place to invest and a better place to put your home office or your regional HQ here.
Real estate services firm Jones Lang LaSalle says that uncertainty surrounding the outbreak is likely to hurt investment activity.
We expect that in the first half of 2020, real estate investment activity will be sharply down on a year-on-year basis. But when I look at other sort of events in the past, for example, SARS in 2003, we find that actually activity will bounce back sharply once the risk recedes. So in the second half, we expect activity to bounce back such that for the whole of 2020, activity levels will not be down.
Occupiers are also likely to take a wait-and-see approach before making any big real estate decisions. This holding pattern could last through next year, when new supply is due to hit the market.
I think in the short term, many are just deferring their decisions as to whether they want to make any aggressive plans to expand. At best, they will just likely renew their leases. And so landlords are also pretty happy that they renew because, we are moving into very uncertain times. Decision makers will defer any real estate decisions. That is, if you are a non-real estate company, all your real estate decisions are not treated as important.
The biggest things that are happening is people are moving all their attention onto safety, security, and contingency planning. Nobody's talking really about real estate right now. And that's a problem because any market is based on a couple different fundamentals, but the biggest one is liquidity. And when you don't have liquidity, markets stop. And that's where we're at right now. How long that lasts, that's the big question mark.
Grade A office rents in Singapore have enjoyed 10 consecutive quarters of growth. According to CBRE, rents have expanded by some 29% since the second quarter of 2017. But the tide is turning.
On the back of no supply, rents are basically peaking out because the delta or the premium between the asking rents for landlord and the what we call acceptable rents by is basically getting smaller and smaller. So I think 12 is a psychological barrier. So we are seeing that most of the deals are fizzling out. Landlords are also quite resistant to raise too high of a rent. So we expect rents to peak out for the whole of 2020.
Without COVID, we were already forecasting a flattish to a slight drop of 1 to 2% for grade A office rents. I think with COVID, the biasness is on the negative side, so we may see rents either holding flat to falling maybe slightly more, 2 to 3%. Now, it wouldn't fall that much because, again, many would rather renew their leases. And landlords know that when you renew their lease, you actually have a better bargaining power. Moving to a new build, a new spec office means that you need costs to fit out. And so landlords may just say, why don't you renew at a rate that is more amenable to both parties.
However, in the longer term, rents could rise even further due to limited supply.
If I look at the next 5 years, supply is actually very short. It is a function of a few things. One is that the government has stopped selling land for office development in the CBD for more than 3 years now. They are trying to focus office development in scalable regional hubs outside the CBD. They are trying to create more job opportunities closer to homes, and also at the same time they are encouraging owners of older office buildings in the CBD to consider redeveloping them into mixed-use developments with residential components. But in the meantime, it does mean that we have less supply than we need of office space in the CBD. So on a 5-year view, we think that rents will actually rise about 20%, even though rents have already risen close to 30% over the last 2.5 years.
Vacancy rates in the office sector have fallen over the years to just 2.3% in 2019. Besides tech firms, co-working outfits have also been fueling demand.
Corporate occupiers are dealing with really short-term business cycles right now. We're in a situation where they're CapEx constrained, and even we've got OpEx issues. And so as a result, people don't want to make long-term commitments to real estate because their business model may change very dramatically. So you've got that as a business driver, which then becomes the need for the co-working or the managed operator model. They can come in and they can cater to these things.